Joining me on stage is going to be a team from KPMG who's going to give us a FASB update. My vision here is that we get one big FASB dump at the morning, and the rest of the day, when we mention it, it's about the edge cases, it's about the analysis, it's about deep diving into all these things. So please welcome on stage, come on up everybody. Please welcome on stage Tony Tooths, who's the KPMG blockchain leader and tax principal, Jason Bui, who's the director at KPMG, and Sanya Mashir, who's the director of deal advisory and strategy. Who's talking first?
I can be the first one talking.
All right, it's the big green button.
Thank you, Pat. And yeah, this is a great setup compared to what we had last year, right? So it's a reflection of the industry where we're all going with this. So yeah, as Pat mentioned, we were excited to finally get the FASB proposal update, the exposure draft that was issued in March. I'm sure you all had a chance to go over the 40-page document, which I think it was quite it was aligned with the expectation what we had been seeing from the industry and what the FASB has been pretty open to the to go out and get commentary and going back to the beginning of the journey, which was July 2021 when they decided to have an agenda about accounting for digital asset, and they have got over 500 comments from practitioner, industry, regulators, and standard setters, and then finally 2 years later, this is what we have on the exposure draft. So with that being said, today we wanted to, I'm sure, like I said, you guys have at least seen or heard about the exposure draft already at this point. Our hope is to provide some commentary and some perspective and what we have been seeing and hearing from our clients as well from the industry, what the initial reaction about this and what what we expect, the type of comments that the FASB will receive between now through the end of June, I believe, and then obviously after that they're going to deliberate and then come out with the final ASU, hopefully by the end of this year. So with that being said, we'll go through what is in and what is out of the exposure draft. So what was interesting about this is that they decided to keep it quite narrow. If you think about the left hand or the right hand side of what is in scope, so they provided 6 criteria, and so long that you meet all of these 6 criteria, you will be deemed subject to the exposure draft. So, and if you think through each of those 6 criteria, there's essentially a reason behind why they were provided. Starting with the first one, it has to meet the definition of intangible assets. So this is kind of like a given because that was the foundation standard that we had kind of been following for the last 5-6 years at this point in terms of the classification, measurement, and recognition of the digital asset. And then the second one is that they don't provide the asset holder with the right to the underlying asset. So the intent of this is to exclude any sort of contract that is not the actual digital asset itself. So contract with customer, insurance contract, guarantee. So those are the type of contract that the FASB intentionally want to be excluded from the scoping of this guidance. And then the next one is that the third and the fourth one is trying to also ensure that we are dealing with assets that are on the blockchain and not has anything to do with any other type of intangible asset like software, licensing, IP, right? Those are the things that obviously also consider intangible assets but are not sitting on a blockchain ledger. And then the fifth and the sixth one is that it has to be fungible. So this is basically clearly with the intention to exclude NFT, and that has been the intent all from the beginning when they started this commentary period back in July 2021. And then the last one is it has to be issued by it's not issued by the entity. If I can read it from here. So this is another kind of last minute insert by the FASB to make sure that if you are the reporting entity that issue your own token, then it should not be included in this piece of guidance. So now let's do the switch over to what is not in the scope. And I think the first two has always been the expectation of the industry, right? So we talk about NFT not being included. We're talking about stablecoin not being included, and those, for the right reason, because I think NFT doesn't have the same burden in terms of the cost minus impairment accounting that we all, both love and hate of that piece of guidance for the last couple of years. And all the trouble that goes through by the reporting entities around how to come up with the correct impairment analysis, right? And what sort of fair value you need to go through with that. You have to think through, the intraday low and all the fun stuff around that. So I think NFT doesn't have similar type of challenges when it comes to the impairment analysis. And then stablecoin, obviously stablecoin, if you meet the definition of a financial asset, such as USDC and those type of stablecoins, then you already follow the fair value accounting guidance anyway. So I think again, stablecoin and NFT was somewhat expected when we were thinking about this piece of guidance. And I think the last two was a little bit of I would say the last minute, but was something that the FASB has debated for quite a while in the background. And wrap token is there has been a bit of a mixed reaction to this. There's some believers that I think if you think about wrap token, take BTC as an example. WBTC is intended to be pretty much one-to-one, right? In the same context as stablecoin. So if you have BTC now follow this fair value accounting guidance, and then WBTC is supposed to be the reflection of that, and now it's remained to be in the intangible asset model. So it's going to look a little bit inconsistency in terms of the classification and fair value management. So there was a bit of a back and forth in terms of why the FASB decided to keep the wrap token out of this piece of guidance. I think they, at the end, if you look at the basis for their conclusion in that 40-page exposure draft, they mentioned about the fact that they wanted to have more time to further evaluate the consequences of the wrap token and how they want to to think through that a bit more. And then obviously they want to slow down this process more by taking more time to think through wrap token. So that was their decision is outlined in the basis for conclusion there. So again, there's a mixed messaging around that from the industry, whether that's a right decision or not, but that's what they end up sticking with. And then the last one is, I think this one is also somewhat controversial as well, because there's some mixed messaging about, if you are an entity that create your own token, and I think we all know this, the cost basis for those tokens sitting on those reporting entities are pretty much close to zero, right? Because it was followed by the intangible asset model, the software model, where you just basically capitalize the engineering costs to create those tokens, which in turn to be quite minimal on their books. So I think the fear of that is if you now end up following this model, it could result in potentially a large day one gain or day one loss, however you want to look at it, if now you have to include these issue tokens on the book. So that's again is the the perspective why it was somewhat being excluded from this piece of guidance. So again, this was a very narrowly defined scope, even though it does apply to a lot of coins out there. But I think what has not been included is remain to be the next chapter for the FASB to figure out, which I think we all know NFT is an animal by itself in terms of the accounting for that. So I'm going to pass on to Sonia to go through a bit more on the actual recognition and management of these tokens.
All right, so I'll cover, it's too loud. So I'll talk about the recognition and measurement, presentation and disclosure aspects of the proposed guidance. So from a recognition and measurement standpoint, there is the initial measurement, and then how you bring those in-scope crypto assets onto your books, and then subsequent measurement, how you account for them going forward. So from an initial recognition standpoint, the proposed ASU does not prescribe any initial measurement basis. What that means is that entities are expected to turn to the existing US GAAP guidance to determine how to account for these or measure these assets when they first come onto their books. So, whether looking to 350/30, general intangible guidance for purchased crypto assets, or turning to 805 when these assets are acquired as part of a business combination, or ASC 606 when these assets are received in exchange for goods or services. The proposed ASU, from an initial measurement standpoint, does provide some guidance on how to account for commission fees, transaction costs, and other charges that are incurred when you're acquiring your these in-scope crypto assets, and the guidance is to expense them unless the entity follows a very specific industry-specific US GAAP guidance that provides very specific guidance on how to account for these transaction costs, such as broker-dealers and investment companies. So that's the initial measurement basis. Going forward, the subsequent measurement is very straightforward. You're to account for these at measure these at fair value, and any changes in fair value are flowing through your current period earnings. The next column here is presentation. So from a presentation standpoint, the headline is you are to segregate your in-scope crypto assets that are in scope of this proposed ASU from the rest of your intangibles. So on your balance sheet, for example, they'll appear as in an aggregate line item separate from your other intangible assets. On your income statement, the gain and losses or changes in fair value will flow through your net income, but separated from impairment and other changes to carrying amounts of other intangible assets. On your cash flows, the cash inflows from sales of in-scope crypto assets that are converted into cash nearly immediately, meaning within hours or days. Those are to be classified as cash flows from operating activities. From a disclosure standpoint, FASB has provided, several new disclosure requirements for these in-scope crypto assets in order to provide stakeholders with, decision-useful information. So, they've bucketed this into, disclosure requirements that are specific for interim and annual financial statements, and then there are some additional disclosure requirements that are only required to be disclosed on an annual basis in your financial statements. So the interim and annual financial statement disclosure requirements are as follows. So for any of your, any significant holdings of your crypto assets, so Bitcoin, Ether, what have you, are to be, you are to disclose the number of units that you hold, the cost basis of those units, and the fair value. And then when you have insignificant holdings, you are to aggregate all of them and disclose the cost basis and the fair value. The other piece that you would include in your interim and annual financial statements would be, if you have any digital assets that are whose fair market value is restricted, you would disclose, the reason for restriction, the nature of that restriction, the duration, the remaining duration in that restriction period, and what criteria you need to meet in order to remove that restriction. So all of that goes in your both your interim and annual financial statements. Now, the incremental disclosure requirements that are specific to annual financial statements only include any disclosures around your topic 820. So fair value measurement disclosure requirements. Then cost basis, so how you came up with your cost basis of your crypto asset, what method you utilize, so whether it's FIFO, average cost basis, et cetera. And then lastly, most importantly, you are to disclose the roll forward of your crypto asset holdings, your in-scope crypto asset holdings. So starting with your opening balance, any additions, so and you have to disclose how you acquired that asset, whether it's through purchase or mining or staking rewards, then any disposals through sale, et cetera, and then any gain and loss. And yeah. So those were some of the recognition, presentation, and disclosure requirements that are part of the proposed ASU, and we'll talk about the effective dates of the ASU next.
So what's the next step after this? So I think, as we mentioned earlier, there's this commentary period going on at the moment where the FASB is collecting feedback and observation, questions, comment. They came out with a list of, I believe, 18 questions as part of the exposure draft that welcome, the industry's feedback on this, and I think they're going to finalize or deliberate on the exposure draft in the next coming months. They have not yet made decision on the effective date, so it remains to be seen when that will be, when they come out with the final ASU, and I think this will be applied on a modified retrospective, similar to the other big accounting standard that came out in recent years in RefRec leasing that was all modified retrospective, which is what we're expecting here as well. And it does apply to all entities, including the investment companies, with some specific industry guidance around the presentation on the balance sheet income statement, but otherwise, this is meant to be applied to all entities. So that's a very high-level summary and some of the perspective commentary from the FASB recent exposure draft. More to come from the FASB, because as we all know, this is a very high-level guidance on classification. There's a lot of issues out there that have not yet been contemplated or addressed by the FASB around DeFi, staking, mining, all that fun stuff, accounting, lending. So more to come from the standard setter around this. And lastly, we want to also let Tony to share some perspective from a tax standpoint as a result of the FASB. So I'll pass on to Tony for the tax update on this.
Thanks. Yeah, finally, some tax. Right, this is the good stuff. So if you don't know, in this country, the accounting doesn't control the tax, so which is different in other countries where we start with the book income, and that's really what forms the basis of our taxable income. So there's only a couple of narrow slivers of the U.S. tax code that rely on book income, and we don't have to get into those here. So really what's going to come from this FASB adjustment is we're going to get a lot of book tax differences, right? The very first one we're going to see, which is going to be humongous, is the day when this takes effect. All of the companies that have crypto assets on their balance sheet are going to book them up, right? Because they're carrying them at the lowest ever value. And so that's going to create a large book tax difference in that year of transition. And then going forward, obviously, as those assets are carried at fair value and they move around and they will go through earnings, but for tax, you won't see that, right? And so for people who are familiar with investment company accounting, you'll recognize that immediately. That's what we see all the time, right? We have this unrealized column. So it forms that walk from book to tax. So we'll have that here, just like investment company accounting. The other thing that in this draft, they said that commissions, transaction fees, and other things will be expensed. That's not the way the tax does it, right? If those expenses are coming from the acquisition of the crypto asset, then they'll be capitalized into the cost basis. So that'll create a different change. One of the interesting things that I saw in this exposure draft was the way that they dealt with taking crypto for services and products. If you immediately transform that into cash, then you'll just treat that as income from operations, which is great. I wish we would do that for tax, but we don't, right? So for tax, we'll actually recognize those transactions. And so if I sell something for ETH and then I sell the ETH for cash, or stablecoin, right, I'm going to recognize the taxable gain or loss. And so, by the way, that does get into real problems. We saw that this past year. A lot of the reporting companies that we worked with, a lot of them took crypto from their customers of all sorts. If you take stablecoin, probably not a problem, but a lot of people took other types of assets. It was a wrong year to do that, right? Because if they sat around with ETH sitting on their balance sheet from early in 2022, it went in one direction. And so what ends up happening is very bad. In this country, you wind up with a big chunk of ordinary income followed by a later capital loss, which you can't use because in an operating business, you rarely have capital gains. So be wary of that. Do convert it into a stable coin immediately or fiat. And then the other thing that was in this ASU is the wrap tokens. As Jason was saying, they left it out here, which is odd because you could have an asset on your balance sheet which is carried at fair value. And if you want to, you could wrap it and cause it to go back to the intangibles kind of setting, carried at lowest value. And if you want to change that again at another time, whether that's advantageous to you or not, you can move it back again, which is kind of weird. So we try not to have that kind of electivity in tax world. We don't like taxpayers to be able to game the system that way. So currently, the way that we treat it is that when you wrap an asset, it's not a taxable exchange. And so you keep your same cost basis, you keep your same holding period. Now, that's not a rule. The IRS hasn't given us a rule yet. And so one of the things that I do worry about with this ASU coming out, even though our tax system isn't generally controlled by book income, but because the tax rules are still being written, I worry that some people on the Hill will look at this as, oh, look, that's the way that book is doing it. Maybe we should do that too. And so there's certain things we don't want to have happen, and that might be one of them. And by the way, as this is all transpiring, you might have noticed that finally, after 10 years, the IRS is finally getting on it. And so we are actually getting a lot of guidance that's coming out, right? The first piece of guidance they gave us in 2014, and then they went silent for like 6 years, and then just kind of piecemeal dripped out a couple of things. Already in 2023, we already have about 6 pieces of guidance from the IRS, including one that just came out yesterday, basically just telling you that, no, you cannot treat Bitcoin as currency, even though some countries do. But so you're starting to see this deluge of guidance come out of the IRS, and so some of it will play off of the accounting rules, some of it will not. So just keep an eye on that, and I think what you're going to see is a lot more guidance coming out, including next week. Please keep your eye out for the broker reporting rules, which is very, very important for our world, because it's going to tell us who has to 1099 people for payments of crypto, who has to keep the cost basis of crypto. So that's a really big deal, because if you get pulled into that net, it's quite a heavy lift with systems and people to try to do that. So be on the lookout for that next week. And that's Big Tax Update.
Yeah, well, thank you, Tony, and hopefully you guys found it insightful in terms of the perspective we have on the exposure draft, and looking forward to get a lot of comments around this. And I think we're part of the industry group, so love to connect with you all to hear your comments on this exposure draft. And thank you again for allowing us to share this exposure draft with you guys.